Hello, everybody. Ed Yardeni here. It's Monday, 11 a.m. in New York, and Cooper just crossed our path. I think Max is over there. He's a little bit off camera, but at least he's awake, so he's paying attention. It's July 20th, Monday, and are we having a great time or what? Well, let's see. We've The market hasn't been all that much fun when you look at kind of the overall averages. The S&P 500, we were talking about a June swoon, and that kind of what happened. We had a bit of a dip in the market during June, but nothing significant. There wasn't even much of a buying opportunity. Then in July, if we take June and July together, we have what I would call the summer stall. Market just really got up to 7,500 on the S&P 500 way back in May 14th, and here we are still back at 7,500, and Max is taking note of that. How much longer is this stall going to last? Well, my thinking is it'll probably last through the end of the summer, through August, and then I think things will get better over the rest of the year. Maybe I should say through September, because everybody's got this notion that September is always a bad month, and it's not always a bad month. And maybe after kind of having the stall from May 14th until the end of August, we'll do whatever correcting and rotating we need to do. Because as we all know, beneath the calm surface of the S&P 500, there has been a lot of rotating going on, and some significant correcting going on, particularly in the information technology space. But there's still, I think, on balance, a dip buying mentality in the market. There's still lots of cash either on the sidelines or that wants to rotate from one area to another area when there's dip opportunities. And that still seems to be the way the market's operating. We're still looking for the S&P 500 to end up the year at 8,250. Everything we see on a weekly basis in terms of earnings still looks mighty fine. It still looks like FEMA, fabulous earnings momentum. That certainly was the case with last week with the financials, with an outstanding performance by Goldman. They say the stock market isn't the economy, but maybe Goldman is the stock market. When the stock market's doing well, Goldman's doing well. When the stock market's doing well, you get more M&A activity, you get more IPOs, and Goldman obviously does well in that kind of environment. But the other banks did just fine. By the way, I forgot to mention to you, a few weeks ago, I went over to visit our friends at J.P. Morgan in their new building, and one of the PMs there was very, very nice and spent an hour with me before the meeting, taking me around to see the building. And if you ever have an opportunity to get a tour of the building, it is massive. It's a city block. I don't know how many floors it is, but it goes right up there. And they've got like tons of restaurants in there, and pop-up restaurants, all sorts of fun things. And it's really a sight to behold. Now, I know there is a tendency to look at history and show that when companies build huge headquarters, that's usually the top in the market. So we want to keep that in mind, but let's not get too hepped up on that at this point. I mean, history does repeat itself, and a lot of things that happen over and over again will do that. Another kind of contrary indicator I've pointed out recently is that foreigners bought $900 billion in U.S. equities over the past 12 months. And usually foreigners don't buy at the beginning of bull markets. They're aggressive buyers at the end of bull markets. So the contrary indicators are kind of out there. The bull bear ratio, the last one we had was over 3 again. And that's kind of, from a contrary perspective, not particularly bullish because there are too many bulls. But on the other hand, it's not particularly bearish. Usually, readings closer to four would be of more concern. But I think right now everybody's kind of confused. The market's got AI fatigue. No, I think we've all figured out that we can't figure out who's going to make a lot of money in AI and who's going to be left holding the bag and losing money and maybe going out of business. There's a lot of concern, as you can see in the stock market, with Oracle. Oracle's going down, and they're very heavily tied to OpenAI. And a lot of people are asking the question whether OpenAI will have the money, the revenues, or the ability to borrow money or to raise money in the equity markets to make good on some of the contracts that it has with Oracle. So that's kind of something to watch. But that doesn't mean that things can't blow up along the way without causing a 1999, 2000 style bubble and tech wreck. There's a lot going on here, and a lot that makes sense, that is fundamentally based. It's just trying to figure out how to play that, particularly in the tech arena, has gotten difficult. So well, I think the way people are responding to AI fatigue is not they're not bailing out of the market because they see that other sectors are doing fine. I think what they're doing is going to companies that they know what they do, and they know what their revenues and earnings are now, and they are doing their usual capital spending, and there's nothing kind of out there that requires a great deal of faith and hope and hype to make it work. There's a lot of good fundamentals in AI, but there's a lot of faith, hope, and hype as well in that sector at this point. A lot of confusion. There's this new Chinese model. Oh, there goes Max. Uh, so this new Chinese model from a company called Moonshot has got everybody sort of rattled because it's sort of the latest deep seek moment. But then there's already counter arguments I've seen being made that even the cheaper Chinese models require a tremendous amount of compute, and that's not going to go away just because they're able to come up with models that seem to work, if not more efficiently, more cheaply in terms of tokens. And it maybe that the tokens are cheaper, but you might have to use more tokens to achieve what you want to get out of the AI models. Obviously, I don't have the answers of how this all sorts out. And because of our own AI fatigue, back in December 7th, we went from overweight to market weight information technology and communication services. We still like them, but collectively they got up to 45% of the market cap of the S&P 500. That's been to a large extent justified by their earnings share. Yet 45%, it's hard to recommend overweighting a sector that's already so overweight. And so we did kind of cool our jets. We curbed our enthusiasm is the expression I'm looking for tech and communication services. And we're now more enthusiastic about financials, which look like they're breaking out to new highs thanks to FEMA, fabulous earnings momentum. Healthcare looks like it's finally coming out of its multi-year rut, led by biotech, but also pharma is looking better as pharma acquires more biotech to fill the pipeline for growth down the road. Industrials, they still have plenty of business, even if companies don't increase their capital spending. The capital spending commitments that are sort of already committed to in the ground and are being built, those will continue to keep the industrial sector doing very, very well. So we remain bullish on the market. We don't mind the rotation and the corrections going on, partly because we sort of kind of anticipated them. Well, enough of my jabbering. Let's look at some charts that let's go to the data because at the end of the day, that's what matters the most. As you know, we start out with the data and then come up with our theories and hypotheses as opposed to doing it the other way around. But for the here and now, we've got the S&P 500. As you can see from this chart, this is the quick takes that you received. U.S. market call hanging out at 7,500 and 4.50. So we're kind of in a stall environment as in our opinion. So we have stalled out at around 7,500 since May 14th. Combination of things, AI fatigue, fatigue over the Middle East. The war's not over. Oil prices are back up. There's been a pivot in the markets thinking about the Fed. The Fed's going from an environment of uh, thinking that they would need to lower rates, and now they're thinking about raising rates. Look, they billed the 2024 rate cuts that total 100 basis points, and the rate cuts in 2025 of 75 basis points in total. They really basically billed 175 basis points in rate cuts as insurance that to make sure that the labor market doesn't get weaker. And they were particularly concerned in the dual mandate. There was more concern about the weakness in the labor market than there was concerns about inflation. Um, and it was an insurance policy. In other words, they weren't sure that the labor market really needed it, but just in case it did, they felt that they could do it. So maybe it's time to take back some of that insurance now that the labor market's looking pretty good, and it's not a complete uh, it's not a sure thing. There are some indicators like the latest payroll numbers and revisions that didn't look so red hot. But all in all, if you add up all the labor market indicators, it looks like things are back in the swing of things. We had a lot of weakness at the beginning of the year, January, February, because of the winter. The winter was particularly harsh. So I think some of the rebound reflected that. We're not in the camp that thinks we're going to be losing lots of AI jobs. And on balance, we think the economy, the labor market's doing fine. So we did think that the Fed would pivot to tightening, which they did. We also anticipated that they would raise the Fed funds rate at this meeting coming up in the next few days in terms of the Fed funds rate. With the CPI and PPI, we kind of had second thoughts about that. It's still possible. It's still on the table. There's still some Fed officials that have been uh, talking recently that sound pretty hawkish. So I think there will be a hawkish debate. I don't know if it'll be a family a fight so much as a debate among hawks. I think most Fed officials now certainly are not. I think there was one official that thought that they needed to lower rates. Everybody else at the June meeting thought. I think nine said flat, leave it alone, and nine said let's raise it. But the sentiment was certainly towards raising interest rates. And I think there'll be a big debate of whether they should do it in July or not. And we'll see. I mean, I think one way or another we'll get a rate hike in July or in June. And in any event, that's what's in the market right now. The 2 year is back to 4.2%. So the market sort of on the CPI and PPI eased off on tightening. And now it's kind of back to thinking, well, on the other hand, maybe there's good reasons for it. And in the morning briefing today, we discussed that. Elias and I did. So let me move on here. There was some churning around in the market, as you can see. And let me take my Dunder Mifflin drink here to. There it is. Now I can talk. Um, so here's the year to date percent change in the S&P 500, basically flat since May 14th. At a 10% increase. The level was 7,500. The year-over-year percent change or year-to-date percent change stayed fairly stuck around 10%. We did see the S&P 493 outperform for a while. Now, not so much. Gave back some of it back. We certainly saw the Magnificent Seven underperform, and now they got some of that back. But still, year to date, the X-Mags are up 12%, and the mags are up 1.4%. So clearly some rotation there. seeing some rotation between growth and value. Growth looks to be kind of stuck up here. Value making a new high, and that includes financials and energy. And energy's made a comeback here on the latest round of fighting in the Middle East. We did show this table, this chart showing all the since May 14th, the kind of rotation that's been going on. You can look at it on your own. Maybe you have already. Meanwhile, FEMA, fabulous earnings momentum, just keeps rolling along. The second quarter estimate is 22.9%. That's on a apples to oranges comparison. So we're comparing today's S&P to the S&P as it was a year ago. And you can see that there was a little dip here, and now with the financials reporting, this kind of rose back up to a 22.9% increase. And then you've got these FEMA growth numbers of over 20%, which they're not letting up on. They're still looking for those kind of numbers, and that's the analyst consensus. On an apples to apples basis, which is the way Joe has been able, my colleague Joe Abbott, nobody slices and dices these numbers better than Joe. And so I asked Joe, give us a chart so we can track the year-over-year growth rate for the industries for the second quarter. So this is second quarter 2026. On a apples to apples basis, the growth rate is quite a bit higher, 26%. But energy is leading the way. Information technology is huge, 65.6. Financials is pretty good, 20.2, and you can see that got pushed up with the last week's report. And healthcare doesn't look that exciting, but the stocks have been performing better. Forward earnings, all-time record high again. We're converging towards the 2027 number, and the 2027 number keeps going up. It's up to $404 a share. By the end of the year, the market will be discounting forward earnings. What will it be? Well, if it's 400 and you multiply it by 20, you get 8,000. And if you get more earnings, you get above 8,000. If you get more PE, you'll get above 8,000. And so we're counting on one way or the other getting up to 8,250. Forward revenues on a weekly basis continues to be very bullish, not just on the U.S. economy, but the global economy, because S&P 500 companies do business overseas. So that's looks really quite remarkable. And it works pretty well. Back here, when the economy slowed down, it was showing you that. And then when it started to pick up, it showed you that as well. And it really helped us get that period right. The analysts don't see recessions coming, so that's my job. That's your job. The analyst's job is to tell us on it how things are going when the economy is doing well. They're just not economists, and they don't get the kind of feedback from their companies that allow them to give you a heads up, a sufficient heads up on coming recessions. And you can see that here. This is the forward earnings per share of the S&P 500 weekly versus the actual annualized quarterly numbers, all-time record high in the annualized. And this is actually going up at a faster pace, and we've dubbed it FEMO, fabulous earnings momentum. We've had FEMO before coming out of this slowdown here. It really picked up. This was a FEMO kind of market. Profit margin. Interesting question that we're looking into. One of our accounts said, how much of this record high increase in margins, particularly in forward profit margins, is really simply a function of semiconductor pricing, particularly the memory companies? And obviously a lot of that is. And could these profit margins just collapse once capacity catches up with demand, particularly in semiconductors and memory? And the answer is sure it can. But on the other hand, the dynamics of information technology, it seems to be moving at a faster pace. I've always said that information technology does creative destruction better than anybody else. They're constantly destroying the latest new thing with something even newer and better. And when they do that, they get to keep a higher profit margin, while the profit margin on the old thing, which nobody's buying, takes a dive. So that's something to consider when you kind of try to puzzle out whether this surge in memory names, semiconductors, is sustainable or not, whether the profit margins are just a sign of irrational exuberance, or whether there's some reality in the way things work. Um, Again, technology literally eats its young. As soon as a company comes up with a new chip, they're already working on the next chip. They're working on destroying the current chip that's red hot, because they know if they don't do it, one of the competitors will do it. And so it really makes your head spin, makes my head spin. I don't want to speak for you, but maybe you got it all figured out. But certainly the pace of change is extraordinary. And where I'm working with Melissa, who's become our AI prompter. She's really good at it. But we're working on creating some AI systems that just will kind of sort it all out for us and keep us at least informed about what's going on. And if it works for us, we'll share it, certainly share it with you. Um, Meanwhile, earnings earnings breadth continues to broaden out. On a 3-month percent change basis, forward earnings are up 89.4%, kind of near previous cyclical peaks, maybe even one of the higher ones. I think other than this, it kind of matches this one, but it's higher than it's not as high as this one. But other than that, it's kind of exceeds them. So is that bearish? Not necessarily. I mean, there's no reason why the growth rate couldn't stay high, but we'll be watching it. Not sure that it's so much of a leading indicator as you can see. Again, the analysts don't do recessions very well. But then the trick in this business is uh, to be a macroeconomist and try to do the best you can to figure out if there's going to be a recession. If not, if you agree with us that the economy has demonstrated its resilience since the beginning of the decade and even before that in the Roaring 2020s thesis, if we're not going to have a recession, then analyst expectations tend to be actually pretty accurate. And so maybe that is a sustainable kind of growth rate. Meanwhile, on the credit side, this is our weekly market call after all. So we don't look just at the stock market, but we got no problems with the bond market yield, just fluctuating for the rest of the decade between 4 and 5%. That's what it was before the great financial crisis and the great virus crisis. That's kind of where it was before the great inflation crisis, and it took a while for inflationary expectations to get rooted out and to kind of get back to that normal. So this is not abnormal. People kind of annoy me when they say, we have to expect higher for longer. I guess it annoys me when other people come up with catchy phrases here, but higher for longer doesn't do it for me. We're not higher for longer. We're normal again. Is kind of the way I'm looking at it. Okay, so this is just showing you the everybody's focusing on private credit, but meanwhile, public credit spreads remain very tight, and that's helping to keep a lid on the VIX. Let me run through a couple of charts on this one. All this is obviously relevant to our discussion. What's the Fed going to do? I think the markets certainly have discounted that the Fed is in a hawkish mood, and the discussion at the July meeting coming up is going to be whether to raise rates in July or to wait. And it's probably going to be actually a close call, but we'll see. I don't think they're going to want to have any dissenters, but you never know. They didn't have any dissenters last time. Uh, Kevin Warsh will probably argue for holding off on responding, though he has come across as very hawkish. Maybe he wants to get his credentials as a hawk by actually doing it in July, but we'll see. Meanwhile, Mr. Warsh has said that he is completely on board with the Fed's 2% inflation target. He has no intention to change that. But on the other hand, he's saying, Well, on the other hand, maybe we want to figure out which inflation we're actually targeting at 2%. Since January 2012, the Fed has been targeting the PCED, the personal consumption expenditures deflator. It often, on a short-term basis, focuses on excluding the volatile food and energy, so it trims it by looking at PCED X food and energy. But there's other ways to trim it. So, for example, there's the Dallas Fed trimmed mean PCED. We'll be writing more about these things. Just maybe put a little package together, just so you can, in one fell swoop, see the differences between. There's other kind of underlying inflation rates, but you can see that if Warsh is trying to get the Fed or the task force to recommend uh, using the Dallas trimmed, it wouldn't have made much of a difference back here, I think. But then all of a sudden, we're looking at the trimmed at 2.4, getting pretty close to 2%. And whereas the PCED is 3.4%. Unit labor costs could be another way to look at underlying inflation, and that's 0.5. I think at least it's telling us we're not in this kind of wage price spiral environment, which is what we had when there was supply chain disruptions, price of oil surged, there was a shortage of labor. So price of oil has surged this time, but some of those other inflationary spiral developments haven't occurred of late. You can look at this on your own for those of you who get the morning briefing. Meanwhile, I want to leave a few minutes for our Q&A. So I got only one question so far, so maybe you're making it easy on me, but you know, uh, make my day. Throw some more questions if you have. Okay, Shannon. Do you see the trend of partially bypassing the Strait of Hormuz and other countries looking to increase energy production using American ingenuity as having a long-term impact on energy markets and potentially being one of the main legacies of the conflict? Or are these changes short-term? No, I think your questions in some ways are rhetorical. They kind of answer the question. I think it's very likely that we will see that this is having a long-term impact on kind of the geopolitical risks of the current way we run oil and even fiber optics. There's a lot of cables that go through the Strait of Hormuz, and one of the recent threats by the Iranians, the IRGC to be exact. Oh, I didn't notice the Max came back. But one of the threats now is that they're going to cut the cables, and that would be pretty disastrous for the global financial system. Particularly the countries that rely on that telecommunication system in the Middle East around the Persian Gulf. That's already causing some scrambling around to figure out how Skylink and maybe other technologies can be used to get around this risk of fiber optics. But certainly, the Saudis kind of anticipated, maybe not sufficiently, that they should have a pipeline going from the to bypass the Strait of Hormuz and to, let me just turn this off, to bypass the Strait of Hormuz and go straight to the Red Sea. But now the Houthis are threatening that they're going to start meddling in that part of the world. It is extraordinary how calm, relatively calm, the price of oil has been. Let's not forget there was actually a bear market in oil before the war, and so there was plenty of oil before the war. And you would think that with the war, prices, some people were talking about 150 to 200 and didn't go up that high, went up to, I think, 120 pretty early on, then kind of meandered around 100. And then as soon as the ceasefire happened, boom, it went straight down back to where it was pre-war. So there does seem to be a lot of oil out there. I think also the world is less energy dependent. and that's a factor. But the short answer is, yeah, this geopolitical event is going to have long-term consequences for sure. And since we don't really know how it's all going to get settled one way, I mean, you presume this isn't going to go on forever, but since we don't know, there'll be clearly other geopolitical issues. Adi, how do you see oil reacting if and when China's demand comes back online? Well, it's a good question. That's one of the reasons that oil prices did take a dive is Chinese demand stayed muted. They used their strategic petroleum reserves. But China's economy has also been slowing down. They have made significant progress in moving towards electric vehicles. There goes Max using electric vehicles in to get around, and that's obviously an efficient way to do so. Um, so I'm not sure. Right now, China is still relying on dumping exports to the rest of the world, and the rest of the world is kind of starting to react badly and isn't welcoming of what's going on here. So I'm not sure that China is going to suddenly be coming on stream with a lot more demand for oil. Then again, the Ukrainians are bombing the living daylights out of refineries in Russia, and the Russians are actually importing refined products from India. So it's a small world after all. Small world after all is my kid's favorite ride in Disney. They have that song. Anyways, Nick, if the Democrats are successful in gaining a majority in the House or the House and the Senate, how do you think the markets will react? I mean, it's ugly now. It'll get even uglier in terms of partisanship. I think President Trump has said a few times that he expects he'll be impeached again for the third time if the Democrats take the House. Um, so it is kind of interesting how this will all happen. Meanwhile, the Democrats are moving faster and faster to the left, and I don't know if that's going to be a winning strategy in terms of the final elections, Democrats versus Republicans in these races. But I think the bond market apparently has a history, and I got to go double check this, but I've heard from informed sources that the bond market does reasonably well when we've got gridlock in Washington for obvious reasons. Those, I mean, gridlock is fine if they can't increase the deficit by spending more and taxing less. But gridlock's not so great if they've already done that, and we're now looking at federal deficits of shall I, how can I say this delicately? $2 trillion at an annual rate. Kevin, China's. I got two more questions, and then we'll take a break until next week. China's AI companies appear to be competing aggressively on price, making advanced AI models much more affordable. How do you think this changes the competitive landscape for U.S. AI leaders? Could lower pricing compress margins and lead investors to reassess the premium valuations currently assigned to many U.S. AI companies? Those are all great questions, and I don't know that I or anybody else has a definitive conclusive answer to any of those, which is why we're getting AI fatigue, because we're all struggling to figure that out. I don't think we've ever had I guess we had the situation with the railroads, with huge amounts of capital were committed to building the railroads, and some of them did very well, but a lot of that was through M&A because a lot of them didn't do well and got bought out and consolidated. So that may be sort of a model, but there was a lot of money that was speculative money that went into railroad stocks, uh, and most of it did not make money. So that's not a happy analogy. But I'm not sure it's a perfect analogy. And I have been reading some articles making the case that cheaper token models don't necessarily mean cheaper bills when you've got to run them more often, longer because they take longer. So there's a lot of moving parts there. Uh, William, final question. The reduction of oil imports by China is pretty stunning. Do you think that this is a swing factor for future oil prices? That's related to the previous question. Uh, my hunch is that some of it is actually related to the weakening in China's demand, and that's maybe going to be here to stay. China's made tremendous progress in alternative energy sources like solar, for example. I don't know how, I think they use wind quite a bit. I know they sell windmills to the rest of us, and some of them don't last very long and they create more problems than they maybe are worth. But they certainly have moved aggressively into solar. Well, with that, on a solar note, I hope it stays sunny for all of you this week, for all of us. It's a light week in economics. On the other hand, there's lots of earnings reports. There's Fed speakers up ahead as well. But all in all, we're kind of thinking summer stall here for a while with a lot of rotation and correction underneath it. And it might just be worthwhile just to kind of hang in there rather than try to play all the games that people are playing. But I'll leave that to you folks to figure out. This is what you do for a living more than I do, and I appreciate that you call in and listen to me, and we have these conversations. All the best.